Welcome to The Explainer. Today, we're diving deep into the RBI's latest monetary policy from October 2025. Now, this one's got some really fascinating twists and turns, and we're going to break down exactly what it all means, especially for you. So check this out. We've got a really interesting puzzle on our hands. On one side, the Indian economy is absolutely firing on all cylinders. Growth is fantastic, and on the other, inflation, which has been a huge headache, is finally cooling down. So, the big question, the one everyone's asking is, with such a rosy picture, why did the Reserve Bank of India decide to, well, do nothing? Why hit the pause button? Let's get into it. All right, first things first. Let's talk about the main event. What was the big decision from the Monetary Policy Committee, or the MPC, after all their meetings? And the verdict is in. And it was unanimous, by the way. Every member agreed. The MPC has decided to keep the key policy rate exactly where it is. This is a classic wait and watch move. They're basically saying, okay, things are looking good, but let's just hold steady for a bit and see how things play out. And here is the magic number, the one at the very heart of this whole policy, 5.50%. The policy repo rate remains unchanged. Now, for all of you preparing for exams, this is the very first number you need to highlight in your notes. Super important. So for anyone who's new to this, just think of the repo rate as the RBI's main control lever for the entire economy. It's the rate at which it lends to banks, which in turn influences every single loan out there, from your personal loans to massive corporate borrowing. It's a big deal. Of course, the repo rate doesn't operate in a vacuum. It sits right in the middle of what we call the policy corridor. You've got the SDF rate at 5.25% acting as the floor, and the MSF rate at 5.75% acting as a ceiling. This whole setup is like a set of guardrails that keeps the banking system's lending rates exactly where the RBI wants them. So, let's get back to that big question. Why the pause? To really get inside the heads of the MPC members, you have to look at the data they were looking at, juggling those two big mandates, keeping inflation in check while making sure the economy keeps growing. First up, the growth story. And wow, is it a good one. India's real GDP for the first quarter of this financial year shot up by a massive 7.8%. Honestly, this number was a pleasant surprise for a lot of people, and it just goes to show how incredibly resilient our domestic economy is right now. But here's where it gets really interesting when you look at the forecast. So the RBI has actually bumped up its growth projection for the full year to a very, very strong 6.8%. But notice the trend here. They expect things to slow down just a little bit in the second half. That's probably because of some global issues putting the brakes on. Okay, now let's flip to the other side of the coin, inflation. And the news on this front is pretty darn dramatic. The RBI has taken its forecast for the full year and slashed it from 3.1% just a couple of months ago all the way down to 2.6%. That is a huge, huge change. Now, why the big drop? Well, it's mostly thanks to falling food prices and a good monsoon. And you knew there was a but coming, right? Look very closely at that final quarter. The RBI sees inflation jumping right back up to its 4% target. This little detail, my friends, is the ghost in the machine. It's probably the number one reason they decided to be cautious and just wait and watch. You know, a big reason the RBI can even afford to play this waiting game is because India's external position is just so strong. The data shows we've basically built this formidable suit of economic armor that can protect us from global shocks. So, the first piece of that armor, the current account deficit, or CAD, it has shrunk to an extremely comfortable 0.2% of GDP. In simple terms, this means we're not heavily dependent on foreign money to fund our growth, which is a great place to be. Next up, our financial shield. Our foreign exchange reserves are sitting at a massive $700.2 billion. To put that in perspective, that's enough cash to cover more than 11 months of everything we import. That's a huge safety net. And finally, our external debt compared to our GDP is really low and sustainable at just 18.9%. So you take these three things together, a low CAD, massive forex reserves, and manageable debt, and you get a picture of incredible economic strength. Now, this policy meeting wasn't only about interest rates. Governor Das also announced a whole package of 22 other measures. Let's zero in on a couple of real game changers for the banking sector that you absolutely need to know, especially from an exam perspective. Okay, pay close attention to this new bit of jargon. The Expected Credit Loss Framework, or ECL. This is a massive shift in thinking. See, up until now, banks would only set aside money for a loan after it went bad. With ECL, they have to be forward-looking. They have to predict future losses and prepare for them today. It's designed to make the whole system way more resilient. And here are the key dates to circle in your calendar. The new ECL rules, along with some updated Basel III norms, will officially kick in from April 1st, 2027. But to make the change easier, the RBI has given banks what they call a 4-year glide path, basically a transition period, until March 2031 to get fully up to speed. The RBI also wants to get more money flowing into the capital markets, so they've given a couple of key lending limits a serious boost. I mean, just look at that jump in IPO financing. It's more than doubled to 25 lakh rupees per person. And lending against shares? A 5-fold increase to 1 crore. That's a huge change. All right, we have covered a ton of ground. So let's just pause, take a breath, and boil it all down. As someone studying for an exam, what are the absolute must-know takeaways from this whole announcement? Okay, this slide right here is your ultimate revision cheat sheet. So let's connect the dots. The repo rate is on hold at 5.50%. Why? Because even though growth is strong at a projected 6.8% and inflation is low right now at 2.6%, the RBI has this huge safety net of 700.2 billion in forex reserves that gives them the confidence to just wait. And looking ahead, the two big new things to remember are that ECL framework for banks and the much higher IPO finance limit of 25 lakh rupees. Got it? And this quote from the governor's statement really sums up the whole philosophy perfectly. The RBI is basically saying, hey, we can't do this alone. They see monetary policy as just one part of a bigger team effort, working hand in hand with the government to reach India's long-term growth goals. So there you have it. The RBI has chosen stability for now, playing it safe in a pretty complex world. But this leaves us with that one critical, forward-looking question. What's it going to take to make them move? Will it be a sudden spike in inflation, a worrying dip in growth, or some big surprise from the global economy? That's what we'll all be watching for next.